Let's be honest, financial news is boring. Charts, jargon, and men in suits make it feel like it's not for you. But every so often, history sends us a warning, a postcard from disaster saying, "Wish you weren't here." Right now, in late 2025, it feels like that postcard just arrived. Postmarked October 1929. Every great financial crash follows the same simple pattern. It's not a mystery, it's a blueprint for disaster, repeated again and again. The terrifying part? All 5 stages of that blueprint are flashing red in our global economy today. We're told these crashes are unpredictable, black swans. That's a lie. The warning signs are always there, for those who know where to look. Insiders see the smoke and quietly head for the exits. The rest of us are told the party's just getting started. Tonight we'll connect the dots from 1929's forgotten warning to the precarious ledge we're on in 2026. This isn't about panic, it's about understanding. Because the only thing more expensive than paying attention is not paying attention. We'll break down the 5 stages of a financial meltdown, in plain English. No jargon, no confusion, just the truth. The economy isn't as complicated as they want you to think. The real question is, will we listen to the warning this time? Let's look at the blueprint before it's too late. Because history doesn't repeat, but it sure does rhyme. September 5th, 1929. The roaring 20s are booming and everyone's getting rich. Shoeshine boys are giving stock tips. Enter Roger Babson, a stats-obsessed economist. He stands up and warns, sooner or later, a crash is coming, and it may be terrific. The reaction? Laughter, ridicule, and dismissal. The experts, like Yale's Irving Fisher, insist stocks have reached a permanently high plateau, dangerous debt, risky speculation, and a market built on borrowed money. He was ignored. 47 days later, the market collapsed. Black Thursday, then Black Tuesday. Fisher lost everything. Babson, who acted on his own warning, kept his fortune. The lesson: in a bubble, the person who sounds crazy is often the only one telling the truth. The experts always say, this time is different. It never is. The warning signs are there, if you're willing to see them. Babson saw the rot beneath the surface. Most people just saw the party. The real risk isn't being wrong, it's refusing to listen. History rewards the prepared, not the optimistic. The next Babson is out there, shouting fire. Are we listening? The blueprint hasn't changed. The crowd always mocks the messenger, until it's too late. The question is, will we be ready when the music stops? Sometimes the only sane person in the room is the one everyone ignores. Don't be the last. Every bubble starts with a credit explosion. Money becomes too easy to borrow, and people make reckless bets. In 1929, it was margin debt. People borrowed up to 90% of a stock's price. When stocks fell, fortunes vanished overnight. In 2008, it was mortgages, ninja loans, no money down, financial madness. Today, we're not just at the open bar. We're doing keg stands with debt. Total U.S. debt, government, corporate, household, is higher than ever. The government owes over $34 trillion. Interest payments now outpace the defense budget. Corporations have binged on trillions in debt, often just to buy back their own stock. Hidden leverage is everywhere, through exotic financial instruments. The debt party makes the roaring 20s look tame. The floor is buckling, but the music keeps playing. Stage 1 isn't just active, it's on fire. The warning: when debt is this high, the hangover is brutal. The system is built on borrowed time and borrowed money. The question isn't if the bill comes due, but when. The first stage of disaster is already here. Stage 2 is the concentration trap. Everyone piles into the same can't lose bet. In 1929, it was radio stocks. In 2000, dot-coms. In 2008, mortgage-backed securities. Today, the Magnificent Seven, Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla, make up over 30% of the S&P 500, 7 stocks out of 500. The most concentrated market in modern history. Passive investing makes it worse. Index funds keep buying more of the biggest stocks, creating a feedback loop. Everyone is making the same bet, whether they know it or not. It's like building a city on a single pillar. If it cracks, everything falls. The system is fragile, not diversified. The eggs aren't just in one basket. They're in a jewel-encrusted, AI-powered, wobbly basket. The risk: if these giants stumble, the whole market shakes. Concentration creates the illusion of strength until it doesn't. The warning: monocultures always collapse. Are you sure you know what you really own? The second stage is set. The pillar is wobbling. The crowd is all in on the same bet. What happens if it goes wrong? Stage 3. Insiders quietly head for the exits. In 1929, the Rockefellers and Kennedys sold out before the crash. In 2007, hedge fund legends and corporate execs dumped their shares while the public kept buying. Today, corporate insiders are selling at historic rates. Bezos, Zuckerberg, the Waltons, all cashing out billions. They're not warning you, they're selling to you. Retail investors are buying what the smartest people are desperate to unload. It's the greatest magic trick on Wall Street. Wealth moves from the informed to the uninformed, right before the curtain falls. The warning: when the people who know the most are running, pay attention. The exits are crowded, but only for those who see them. Stage 3 is happening now, in plain sight. Are you watching who's leaving the party? Stage 4 is the liquidity illusion. Everything looks fine, but the safety net is gone. Liquidity means there are enough buyers for every seller. When it vanishes, markets collapse. The Fed controls the drain. In 1929 and 2008, they raised rates, quietly pulling money out. The party kept going until suddenly there were no buyers. Today, the Fed has hiked rates at record speed and is sucking money out of the system. The water in the pool is dropping fast. We've already seen cracks. 3 major banks failed in a week in 2023. Classic liquidity crisis. Emergency loans are just a garden hose in an empty pool. Even the US Treasury market has had terrifying flash crashes. The oxygen is being sucked out, but the market feels stable until it doesn't. The illusion lasts until everyone tries to exit at once. Stage 4. The pool is almost empty. The warning: don't mistake calm for safety. When liquidity vanishes, the fall is sudden and brutal. Stage 5. The trigger. The spark that sets the whole thing ablaze. The crash isn't caused by the trigger. It's caused by the first 4 stages. The system is already soaked in gasoline. In 1929, it was a minor British scandal. In 2008, Lehman Brothers bankruptcy. The specific spark doesn't matter. The fire was inevitable. Today, the world is full of potential triggers. Geopolitical conflict, a hedge fund collapse, a banking crisis, political chaos. You can't predict the trigger. It will be a surprise, and the headlines will blame it. But the real story is the groundwork was already laid. The trigger just decides when, not if. The window for disaster is wide open. The warning: don't focus on the spark, look at the fuel, the dominoes are lined up. The only question is which one falls first. Are you ready for the surprise? If the pattern is so clear, why isn't anyone warning you? The system isn't designed to protect you, it's designed to protect itself. Wall Street runs on your confidence. They need you to keep playing, keep investing. Warning the public would be like a casino admitting the game is rigged. So, a narrative is created, permanent growth, buy the dip, stay the course. The financial media amplifies this. Its advertisers need you in the market. Professionals and the super rich see the warning signs and act. The public is the last to know. It's not a conspiracy, it's just business. The system needs your money to fuel the final phase of the bubble. The knowledge gap is real and dangerous. The warning, don't expect the system to save you. You have to see the signs for yourself. That was a lot. If you're anxious, you're not alone. But this isn't about panic. It's about awareness. The goal isn't to predict the crash, but to understand the risk. Markets recover, eventually. But eventually can mean decades. If you're near retirement, that's a problem. Understanding risk means asking hard questions. How much debt do you have? How concentrated are your investments? Are you prepared for a major drop in your portfolio? These aren't fun questions, but they're necessary. Roger Babson asked them in 1929 and survived. Irving Fisher didn't and lost everything. It's not about pessimism or optimism. It's about realism. Know the game you're playing. The permanently high plateau might just be another cliff. What will you do about it?